Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing Holly Energy Partners stock and analyzing its financial ratios. Holly Energy is an oil and gas midstream company. Midstream refers to points in the oil production process that falls between upstream and downstream. Midstream activities include the storage, processing, and transportation of petroleum. Let's get started with the model. This company has a market cap of $1.3 billion, so they're a small cap company. They're trading at $12.72 a share. And to get shares outstanding, its market cap divided by stock price gives you shares outstanding 105 million. Let's look at the financials. Free cash flow is how you value a company. You estimate the future free cash flows and then you discount that number back to today. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Capital expenditures are property, plant, and equipment. And if a company has positive free cash flow, it makes it easier for them to pay down debt, pay dividends, acquire other businesses, or invest back into their business to grow it. If a company has negative free cash flow, it can make it difficult to do those things. And this company has positive and growing free cash flow each year, so that looks really good. Net income is the profit and loss on the income statement. It's revenue minus expenses. Their revenue is pretty consistent and growing every year, so that looks good as well. That's what you want to see when you invest in a company, positive and growing numbers. And their profit margins look really good. I consider a profit margin above 20% good. Obviously it depends on the industry, but their profit margins are between 37% and 44%. Net profit margin is net income divided by revenue. It's how well you convert revenue into profit. So in 2019, they converted 44% of their revenue into profit. That means 56% went towards expenses. It seems to be a really efficient business. Let's take a look at the financial statements. This is the income statement. The top line is the revenue. That's the sales for the year. Below that is cost of revenue. When you're analyzing the income statement, you want to look at the numbers as a percent of revenue. So let's look at the cost of revenue as a percent of revenue. The cost of revenue represents the costs involved in making and delivering your company's products or service to a customer. For example, if you make and sell a physical product, the raw materials, labor, factory costs like utilities and equipment, shipping costs, etc. are included in the cost of revenue. For a service company, the salaries of the service providers and any other cost associated directly with providing the service is a cost of revenue. Certain industries have a higher cost of revenue than other industries. When revenue goes up, it is expected that economies of scale set in and the company becomes more efficient. You would expect cost of revenue as a percent of revenue to decrease as sales increase. If that is not the case, this is something to look into as an investor. You can see the cost of revenue increased each year, but did it increase at a faster or slower pace than revenue? In 2016, cost of revenue was 48% of revenue. Same thing for 2017, 18. It was a little higher in 2019, but it's not much different. It's pretty consistent year to year, so that looks okay. Ideally, I'd like to see this percentage go down as the revenue goes up. An operating expense is an expense a business incurs through its normal business operations. It includes rent, marketing, supplies, payroll for support functions like accounting and legal, insurance, research and development costs, and many more. Operating expenses are necessary and unavoidable for most businesses. Some firms successfully reduce operating expenses to increase earnings. Reducing operating expenses can also compromise the integrity of a business. Finding the right balance can be difficult but can yield great results. Certain industries have higher operating expenses than other industries. Earlier when we discussed cost of revenue, you would expect a company to become more efficient when revenue increases relative to cost of revenue, but this is not always the case with operating expenses. So you can see their operating expenses actually decreased. It went from 13 million to 10 million. So they are doing a better job at managing their expenses. This is a good sign for the investor because that means there's more money for us, but you just want to make sure the company is still operating efficiently and effectively and still growing and still competitive against their peers. So to go back to the income statement, revenue, then cost of revenue. Below that is gross profit, which is revenue minus cost of revenue. Below that is operating expenses. Then below that is operating income, which is gross profit minus operating expenses. You want to make sure operating income is positive, because if it's negative for a long stretch of time, a company will eventually go bankrupt. Below that is the interest they pay in their debt, also the interest they receive from their investments. And you want to make sure this number is smaller than this number, because if this number is larger, that means the company will need to take on more debt just to run its day-to-day operations. Below that is other, and this line item is here because some companies generate money or lose money outside of its main business. Examples are when a company writes down the value of its assets. Another example is when a company sells part of its business. I'll show you what this $35 million gain on sale of security is. You can only get so much information from Yahoo Finance. This is from their 10K, and it mentions what the $35 million is. This is a common agreement with oil and gas companies. It's called a throughput agreement, and what it does is it's a contract between this company and another company, or it's a contract within the same company transporting oil between their pipelines. So it appears that they're rolling their agreement, so they had to close out this agreement and take a $35 million gain, but it's a non-cash item and they're going to roll it into another agreement, so they had to record it onto the income statement for this period. Then they had a $5 million gain on equity interest. This is common with lots of companies. It's called equity method accounting. To explain equity method accounting, it's a technique to record profits when a company has significant influence over another company. So when a company holds 20% to 50% of another company's stock, it is considered to have significant influence. For example, if this company owned 40% of company X, and company X reported $100 of net income, and since this company owns 40% of company X, it would report $40 on its income statement as a gain. This is from the company's 10K, so you can see Holly has significant interest in 3 companies: Osage Pipeline, Cheyenne Pipeline, and Cushing's Connect. And this is Holly's percentage of those companies' profit and loss on their income statement. So Holly has to pass through this gain on its income statement, but this is a non-cash item, so it's reversed out on the statement of cash flows. This is different from cost accounting, where if this company owned less than 20% of another company, it would only report the dividends it received from that company. For example, if this company owned 10% of company X, and company X paid $200 in dividends, and since this company owns 10% of company X, it would report $20 on its income statement, 10% of $200. They also had a $272,000 gain on sale of PP&E. That's pretty small, so I didn't look into it. That's probably just a gain on the sale of some of its equipment. This is a statement of cash flows. To calculate free cash flow, you take cash flow from operations, which is up here, minus CapEx. 2016, they had the lowest free cash flow of the year. The reason they had their lowest amount was because they had $103 million in CapEx that year, much more than in other years. To calculate cash flow from operations, you start with net income, then add back the non-cash items from the income statement, which is right here, then adjust for changes in working capital. Working capital are things like accounts receivable, accounts payable, inventory. Nothing really jumped out at me when looking at this. Everything looks pretty consistent and clean on their financials. Their numbers look really good. Let's look at the capital structure. $1.5 billion of debt, $488 million of equity. They pay 5.25% interest on their debt, and they don't pay taxes because they're a master limited partnership. To qualify to become an MLP, a company must receive at least 90% of its revenue from natural resources or real estate. This company is a bit leveraged. 75% of their capital structure is debt, which means they're 25% equity. Cost of equity is 11%. To get cost of equity, we use the capital asset pricing model, and part of the CAPM formula is the beta. Beta is a measure of a stock's volatility in relation to the overall market. The S&P 500 has a beta of 1. This stock has a beta of 1.13, so if the S&P goes up 1%, this stock should go up on average 1.13%, and if the S&P goes down 1%, this stock should go down around 1.13%. Beta is calculated using regression analysis. Regression analysis allows you to examine the relationship between 2 or more variables. Beta is systematic risk related to the market, like interest rate changes, policy changes, wars, etc. Systematic risk cannot be diversified away. Unsystematic risk is the risk of an individual company, which can be diversified away by adding more stocks to your portfolio. And their WACC is 6.69%, which is a blend of the cost of debt and cost of equity. The WACC is a discount rate companies use when they want to take on new projects. For example, if a new project came along that cost this company $1 million upfront, and the project would generate $100,000 of profit each year for the next 20 years, the company would discount those 20 years of cash flows back to today's dollars using the weighted average cost of capital. If the present value of the future cash flows equaled $1.4 million, the company would take on a project. Since it cost them $1 million, they would make $400,000 profit. But if the present value of the 20 years of cash flow equaled $800,000, the company would not take on a project. Since it cost $1 million, they would be losing $200,000. You only want to take on projects that add value to the company. The WACC is a discount rate we are going to apply to the future cash flows for this model. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $1.9 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2.5 billion. We divide that by 105 million shares. And we get a calculated stock price of $23.44. They're trading at $12.72, so they're trading at a 46% discount. It's a really strong buy according to the model. Simply Wall Street is pretty close to me. They're at $25.44 a share, so they're also saying the stock is undervalued. Simply Wall Street uses the average analyst estimate to come up with their valuation. Let's see where the stock has been trading the past few years. So the stock was over $30 a share for a while, but then it's come down quite a bit the past 6 months to a year. It's at a pretty low point, so it looks like a great value according to my model and according to Simply Wall Street. Let's look at the historical dividends. The dividend was 50 to 60 cents. It peaked at 67 cents a few months ago, but they dropped it almost in half to 35 cents a share. They're really trying to cut costs because of the pandemic. It is good to remember that a company's financial performance is not 100% correlated to the stock price. It can help or hurt the stock price. The only thing that is directly correlated to the stock price is supply and demand of the market. The stock price will go up if there are more buyers than sellers. The stock price will go down if there are more sellers than buyers. It is possible for a company to report great financials and its stock price keeps going down. It is also possible for a company to report weak financials and its stock price keeps going up. The market is forward thinking. Part of investing in the stock market is understanding market sentiment and investor psychology, which can be the hardest thing to figure out. In the short run, no one can predict the stock market, but if you invest in solid companies with good fundamentals and hold long term, you should be better off than most investors. The reason I like focusing on financials is because all the information is there. If you listen to others, they can spin their narrative to make the company look great or look terrible. Let's look at their financial ratios. You can see they have great price multiples because as the stock price goes down, these numbers look better. PE ratio is really good. The median for the market is 15.9, the average is 17.8. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. I like to see below 15, they're at 5.7. So investors are paying $5.70 for $1 of earnings. Price to sales is really good also. The median is 2.0, the average is 4.6. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5. They're at 2.5, so investors are paying $2.50 for $1 of revenue. Price to book is also really good. The median is 2.3, the average is 4.9. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5, they're at 2.7, so investors are paying $2.70 for $1 book value. Equity is total assets minus total liabilities on a balance sheet. Good interest coverage ratio, the median is 3.9, the average is 12.9. Interest coverage ratio is EBIT over interest expense. I like to see above 2, they're at 3.4, so they can easily cover their interest payments. EBIT is earnings before interest and taxes. It's also called operating income on the income statement. ROE is really good. The median is 12%, the average is 13%. ROE is net income over equity. I like to see above 20%, they're at 48%, so they provide a good value to the equity holders. The higher the debt, the better your ROE will look. Current ratio is really good. The median is 1.3, the average is 1.8. Current ratio is current assets over current liabilities. I like to see between 1.2 and 2. They're at 1.3, so they can cover their current debts and payables. Current assets are assets that can be liquidated into cash within 12 months. Examples are cash, accounts receivables, and inventory. Current liabilities are debts and payables that are due within 12 months. Examples are current debt and accounts payable. The best way to look at ratios to compare them to similar companies, I've done videos on 31 oil and gas midstream companies, and Holly is right here. And if Holly has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're a little worse in PE, a bit worse in price to sales, but they're much better in price to book ratio. They're doing fine in current ratio. They're doing amazing in ROE. They have a little more debt than the average. They're a lot smaller than the average. They're only 1 billion market cap. The average is 8.7 billion. And they pay a dividend a little less than average. Their dividend yield is 11%. Average is almost 12%. So to summarize, I have them trading at a 46% discount. Their ratios look decent, but the financials look really solid. Let me know what you think. Give this video a like, subscribe, or comment below. I respond to all comments. Also, if you'd like to do a private Zoom session with me, receive a custom valuation, or support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.